It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being with us today. My name's Mike Bernard. I am your host. I'm also one of the certified financial planners on the show. With me in the KFG studios, certified financial planner and one of my friends, Josh Gregory.
Good to be with you, Mike.
Hi there.
Mike, how often have we said that cash is the lifeblood of a business?
Cash is king, for
That's
sure.
Right. That's right. But how often have we also seen businesses at various stages of their life cycle who have maybe great opportunities ahead of them, but they're starved for cash and they can't go pursue them?
Just had an example this past week. Yes.
That's right. That's why it's so important to have a great working relationship with a banker that can help you access capital when you need it. And that's also why we're excited to welcome for the first time Sheila Gordy from First State Bank to discuss the banking tools and resources needed for a small business.
All right, we've got that. And I'm just going to apologize right now if you've been submitting questions. We're going to get to a bunch of them today, but I've got quite the queue, if you will. So got that and a lot more coming up. If you have questions, keep sending them in. You can do so a couple different ways. wisemoneyradio.com. That's how you find us online. You can submit a question right there on the right. You can call or text 574-222-2000. That's 574-222-2000. Lastly, social media did get a question recently on Facebook that we're going to be addressing later today. So you can find us on Facebook. You can watch every episode on YouTube. You can find us on Twitter as well. Just search Wise Money Radio. Sheila, thanks for coming to the program today.
Thanks for having me.
So we are wrapping up a short series about how legal issues impact your financial life. And really for the past 2 weeks, we've been talking about the legal issues of a small business, succession planning, and so on. And that's why we're excited to have Sheila on the show today. I know how important it is for small businesses to have a great relationship with a local bank, and we're going to talk about that in just a minute. But before we dive in, why don't you introduce yourself, Sheila?
Great. My name again is Sheila Gordy, and my husband Jeff and I live in Elkhart, and we have 3 children. We have my oldest daughter is 26 and just had our first grandson in October. I have a foster daughter who will be 23 next week. She's stationed in Jacksonville, North Carolina at Camp Lejeune. Just had a baby last Thursday.
Wow.
Grandchild number 2. And then I have a son who is 22 and lives in Elkhart. And so we're pretty blessed with a full life and just looking forward to being grandparents. So
That's awesome.
Yeah, and this is a topic that's near and dear to my heart. I love working with small business owners and really helping them build a legacy, and really that is their retirement. So this really fits in with what I'm passionate about. I've been in banking for 30 years. I've only been at First State for 2 years. I was at another bank for 28 years before joining the small community bank, and it was just a perfect fit for me and a transition for the next stages of my career, so I'm happy to be a part of their team.
And the individual that you kind of took his spot, he retired. He was a great friend of mine, great friend of ours, Jack. And so, big shoes to fill, but it sounds like you're filling them really well.
We had worked together previously, and so remained friends for all those years that he was at First State Bank, and he's loving his life down in Florida now.
Yeah, that's right. That's right. Okay, so we've already touched on for just a second how important a relationship is with the local bank for small businesses. So in your own words, why is that so important? Why is that so critical?
Well, there's so many reasons, and we could probably spend all morning just talking about that. But first of all, because business owners don't know what they don't know, right? So there's going to be a need that comes up at some point as their business grows and transitions, and that relationship with a business banking expert is so critical. So the number one mistake that a lot of businesses make is they just know the branch team. And so branch team, that's great for the retail part, making deposits and those types of things. But when it becomes questions about expertise on commercial lending or how do you grow your business to the next step, you really need to have a connection with they're called business bankers, commercial lenders, relationship manager, whoever that expertise is that can help them really help them grow their business.
That's interesting because I often think of a banker as just access to a loan, right, or some sort of capital. But you're describing them more as really an advisor to you. You guys get to peer into a lot of businesses all day, every day. So I'm sure you've got a lot of best practices and things that you've learned from other businesses. And do you spend a lot of time kind of coaching up your customers that are small business owners, or do you let them drive whether or not they're seeking that help from you?
Good question, Josh.
Yeah, it is a good question. The term trusted advisor and consultant is overused, but that is really what your banking partner should be, just like your CPA, your financial advisor, and your attorney. And so all of those together are your team that should help advise you. And a good business banker should be helping consult on, margins, not only, what is the revenue, but what is the bottom line. So many people are focused on, my sales. I grew my sales, my revenue went up, but they're not making any more money. And so your banker should be helping you identify what are the causes of those items. And if you, are just making your deposits and you don't really have that expertise, sometimes you're leaving a lot on the table by not having that consultant.
Great. That's the voice of Sheila Gordy from First State Bank talking to us about the value of a small business relationship. What about this? Here's the curveball. When it comes to a home equity line on your house, it's pretty straightforward. Most of us listening, we maybe have had one. If you have a certain amount of equity in your house, you can draw on that using a home equity line. But with businesses, it's not quite as straightforward, yet the need, I would argue, is even greater. There are opportunities that flash up, and you want to take advantage of them. Inevitably, your business will have a soft patch, and so that line of credit is critically important. Talk to us a little bit about the process, or how to get one, or which businesses can easily get one, which businesses it's harder to get one.
That is a great question. So almost every business has a need for some type of working capital line of credit, whether it be a traditional line of credit or access on a business credit card to make purchases, primarily for inventory. The type of businesses that can most easily access a line of credit would be a manufacturer.
Because they've got collateral.
Yeah, they've got collateral and they have a need for it. And so your banker is going to do an analysis primarily on your balance sheet to identify the collateral first. And like you said, you'd mentioned a home equity, and so that's easy. They've got the equity in their home. They're using that as collateral. But on a business line of credit, we're going to look at the inventory and the accounts receivable. And is that enough to cover the request? And traditionally, bankers look at, and so do CPAs, as lines of credit as short-term liability and should be paid back in 12 months. And so we want to make sure that they can revolve the line of credit, right? It needs to be working capital. You advance, and as accounts receivable come in, you pay that back. So the process that a bank would use to analyze first of all, the need and the amount would be to gather financial information. Most of the time, it's going to be a minimum of 2 years, sometimes 3 years of tax returns, along with current financial statements for the current year, accounts receivable, accounts payable, aging. And then we're going to also look at their personal credit, because in most cases, business owners have to personally guarantee that line of credit. And so we want to look at not only cash flow, collateral, but credit and character. And all of those things factor into the determination. And some businesses, especially e-commerce business, they really don't have a need for a line of credit oftentimes, because they're collecting, through credit cards, and their payment is immediate. And restaurants, unfortunately, sometimes that industry is a little bit more difficult and challenging to lend to.
Right.
And so, not to say that we wouldn't, but it is more challenging to get that done. So every business is different, and the amount really depends on how their inventory turns, how often their cycle turns, and also how they collect their AR. What kind of terms do they have with their customers for payment?
Are you seeing an improvement overall in the health of small businesses that you're working with because the economy's been clipping along so well for a while now?
Yeah, absolutely. It's a good time to be a business owner, that is for sure. So, everybody's making money right now, and it's, and everybody's growing revenue and profits, and that trend has been continuing for the last 3 or 4 years. So, some people think that cycle may be ending soon, but we'll cross that bridge when we come to it.
Well, and so the idea that sticks out to me is opportunity, and you want to be able to jump on opportunities. I have a lot of small business owners who are looking at maybe one revenue stream or one product line that's dying down, and they're building up a new one. And so you're going to want a line of credit. You're going to want a relationship with your local bank to help manage that. What about acquisitions? What about buying commercial property? We've got all of that and more coming up here on Wise Money with Korhorn Financial Group. Time flies.
Wow.
Right?
That was 10 minets.
That was 10
That went
minutes.
quick.
So, do you have are there things that you definitely want to mention about other kind of tools or ways that
I love
local
the
bank
real
can help?
estate. I think I could talk a lot about the real estate. And
Okay.
then you talked about the other products, and this is the mistake a lot of business owners.
You can ignore them.
All right. All right. So there's a cash management suite of products, and
Okay.
really that helps businesses say, how do I pay my suppliers, and how do I get paid for my customers, and how do I protect my business? And so there's a lot of fraud protection tools. Fraud is on the rise, and a lot of businesses do not use things like positive pay. So I'd like to touch on that today. It's so critical.
Let's start with that. It is bonus content for you on YouTube right now, but let's start the segment with that, and then we'll lead into a business acquisition or transition, and then hopefully have time for real estate. And I don't know, it is possible we might dip into the third segment. What do you?
Well, I also wanted to hear maybe some rules of thumb about how much cash a business ought to have on hand. And maybe that would fit well when you're talking about, I know cash management type products has more to do with transactions and things, but those businesses that are building up cash, what's the right amount to have? I think that may be helpful to someone who's maybe a self-employed individual that's just
Yeah.
starting their business, needs to have some coaching on, how to improve the health of their business.
Yep. Sounds good.
So I don't know if we can fit all that in.
Yeah,
but
that's a tough one
We'll
because
see.
we'll
see where it goes.
That's a little more difficult question to answer, right?
yeah.
Yeah, we'll see. We'll see where it goes. And yeah, all right. So we'll just pick up with what are some other tools or solutions the local bank offers, and you can talk about that cash management stuff, and then we'll and Josh. And if you part of that answer, if you want to hit on Josh's point there, that might make it a little
Okay,
more efficient.
sure.
And then we can transition into some of the actual transaction stuff.
Okay.
So. For your small business, do you have an effective way of managing your cash flow? And what about fraud protection? We're tackling that and more with special guest today, Sheila Gordy from First State Bank. This is Wise Money with Korhorn Financial Group. I'm Mike. Next to me, Josh, here in the KFG studios. Special thanks to the attorneys at Ledoux, Curran, and Keene, as well as First State Bank for making the Wise Money Show possible. Really quick, if you have a question, let me just remind you, wisemoneyradio.com, or give us a call, send us a text, 574-222-2000. That's 574-222-2000. We just left off with the hairball of all small business lending issues, and that is a line of credit. I'm just going to tell you, go talk to your local banker and talk to the business expert, the commercial lender, something like that, whatever their title is, to get that solution for you. What about other tools that the local bank offers, Sheila, to help small businesses?
That is a great question. And one of the things that every business needs to take a look at is what we call cash management products. And that helps businesses work smarter, not harder. So, for example, it takes a lot of work off of a bookkeeper's plate or off of the business owner's plate in how they move money within the company. And one of the things that we continue to see is fraud is on the rise, whether that be check fraud, ACH fraud, and just wire fraud. We had a client that was a victim of a $90,000 wire fraud late last year.
Oh my goodness!
Yeah, so things like that can really impact your business, and in some cases put you out of business. And so you need to protect your money. And one of the things that a lot of business owners are not aware that banks offer is a product called Positive Pay. And the way that works is you upload a file to your bank of all of the checks that were written in your payables run. And the bank's going to match that with all of the incoming checks. And you have a lot of different ways that you can do that. You can do it by check number, payee, dollar amount, or a combination of those. And then anything that's not a match, unfortunately, gets returned, or even if it's presented at the teller line, could get declined. And so that's a way for businesses to protect their cash. And yet they have to remember to upload the file, because if they don't, we could potentially return. Most banks do reach out and say, hey, we had these checks that were presented that were not a match, and then the company has, normally until noon or whatever the cutoff is at the bank, to let us know, yes, pay though, that was a valid check, or no, return, that is a fraudulent item. And so just so increasingly important as the technology continues to grow, and people are smart, and unfortunately they look for a lot of ways to defraud innocent people.
Right. That almost sounds like the same process of reconciling a checking account, only you're reversing some of the order, right? You're the business is telling you what checks are floating out there, and that way you can make sure that only checks that they authorized are getting authorized for payment by the bank then.
Yeah, that's right. And we also have a similar product for ACH activity, and that's called ACH Debit Block, where businesses are telling us also what companies can electronically take money from our checking account. They provide us the name. They provide us, there's a code that we work with the vendor to know that that's how the electronic payment will be coming in. And sometimes they can cap a limit on that too, so that there's no way that they can transpose a number. So let's say if you have someone that wants to collect money from you, and you should never have a bill that's more than $5,000, you've capped that, but they've accidentally keyed in $50,000, that's going to be returned even though the vendor was legitimate, the dollar amount was not. So just a lot of tools, and very inexpensive, and the headache of trying to unwind all of that if fraud does happen is a real pain and very time consuming. So protect up front.
Very helpful hint. In fact, I wrote down both of those for Tara to reach out to Jeff Corey to make sure that we've got that in place here.
Awesome.
So very helpful, Sheila. Sheila Gordy's from First State Bank here in the KFG studios with me and Josh. Let's transition and talk about some transactions. So, say a business owner is looking to transition their business to a key employee, and maybe it's taking place over a couple of years where the key employee is going to buy a little bit of stock and then a little bit more, and so on. What is it? Just a line of credit that the business would get, or how does that transaction happen with certain tools that the local bank can offer?
Yeah, that's an excellent question, and there is, acquisitions are really on the increase, as we mentioned, in the earlier segment, that companies are very profitable, so they're looking to sell and when they can, and so it creates opportunities for other people that may be looking to buy into a business. So there are so many loans that are available to take care of that situation. A line of credit isn't really what I would recommend, because, as we said earlier, a line of credit is really for debt that's 12 months or less, and used for your inventory and your accounts receivable. So you would want to look into a term loan to fund the stock purchase, or if it's an asset purchase for the business. And there's a lot of different ways to fund that, depending on the strength of the individual that's making the acquisition. So we have conventional financing, and again, we would look at the strength of the person that would be buying into the business, and the collateral that they may have to offer from personally, but also from the business. And if they can't really make the conventional financing work, we can use SBA, the Small Business Administration financing. Great partners. There's several programs available to help make that work. And then in some cases, oftentimes there's a combination of the SBA financing, conventional financing, and also what we call seller financing, where the exiting owner is willing to hold back a note for a portion of that. Oftentimes, the struggle is for the person that wants to buy that business to come up with the equity needed to make that happen. And so all of those products can be used together to make it work.
What about buying commercial real estate? We are big believers in owner-occupied real estate. If you run a small business and it's feasible for you to purchase the building that you're operating out of, we have just seen the financial benefits of that. So is that similar to just buying your residential house and getting a mortgage on that, or what's the process like for buying a commercial property?
And it is similar in a few ways, but it's a lot more involved and complex. And so the reason I say that is there's the appraisal itself costs a lot more than a residential appraisal, and it takes a lot longer. You would have environmental due diligence that you need to do, and so the timing is quite a bit longer than buying a home. And also there is down payment requirement. You would normally need to get conventional financing 20%. On the residential side, you could do FHA. Sometimes you can get in with 3%. It's not the case on owner-occupied. But we are also very much proponents of businesses owning the real estate pay yourself as opposed to paying a landlord.
Yeah.
But there's still ways, just like on the acquisition of a company, you can do SBA financing to bridge that gap if someone doesn't have 20%. So with SBA financing, you could buy that property with as little as 10% down. And also, again, if the seller was willing, maybe they would be willing to hold a portion for seller financing too. So long-term financing, you can fix the rates for a longer period of time, and it just makes excellent sense. So again, we would want to analyze all of the financials of the business to make sure that they would be able to afford the rent payment on that real estate. And then we would recommend most of the time that they hold that real estate outside of the operating company into a separate entity.
Right.
How do the interest rates compare between a conventional loan versus the SBA loan? Is there much of a difference?
There is, in the fact that there's an SBA product called a 504, and with that, it is a 20-year fixed rate, which you cannot obtain from a bank. And so there's fees associated with that, and so sometimes you have to go through the analysis of that, cost-benefit analysis with the client to say, yes, you are paying a fee. However, if you look at, hedging your interest rate risk, and that for the SBA portion, you're locked in for 20 years. And with that particular product, the bank is a partner with the SBA. So we fund 50% and the SBA is 40%. And so our portion wouldn't be the 20-year fixed rate, but at least a portion of that debt is locked in for that period of time.
How long would you lock the rate?
We would lock it up to 10 years.
Okay. Sheila, this has been very helpful. How do people get a hold of you if they have questions or need to get in touch with you?
They can email me at SheilaG@bfirst.bank. That's SHEILAG at B as in boy, first spelled out, .bank.
Chris sent in a question about should he do pre-tax or Roth contributions. We've got that and more listener questions coming up here on Wise Money with Korhorn Financial Group. Okay.
Great job.
So, yes, that was wonderful. For
Awesome content.
a little bonus, because we missed a couple things on there, so a little bonus content for YouTube, and I'll even tease that out as I start the next segment. Okay, so the process for buying a business auto. Is that very similar as well? Do you need more down? Do interest rates differ much from just a personal auto loan?
Well, each bank does things a little bit differently. At First State Bank, we offer our businesses the same rate we would offer a consumer on the business auto purchase.
Wow,
So,
great.
yeah, and so very competitive. But, oftentimes the dealers have better rates than a customer can get at a bank. And as much as I'd like to do a loan for a business owner, I'm always going to say check with the dealer first. And if they can get a 2.9%, you're not going to get that at a bank. And, take that offer and run with it. But it would be the same amount of information that you would have to give us for that auto purchase. All of the financials, a personal financial statement. And sometimes people's like, I just want to buy a car. That's a lot of paperwork to do just for that. And unfortunately, that is the process. One of the things that can kind of help businesses with that is if you are working on a line of credit, oftentimes your relationship manager will set up a equipment line for a 12-month period to fund those purchases that your business may have, auto loans. Maybe you want to buy a piece of equipment. So the approval's already there. All you have to do is give an invoice.
Ah, interesting.
So that saves a lot of time.
Yeah. Very, very helpful. Thank you so much for being on the show.
Thanks for having me.
We'll need to
great.
do it again.
All right.
So,
Love to.
because you can see how fast. Thank you so much for being with us today. This is Wise Money with Korhorn Financial Group. I'm Mike, joined by Josh, and Kevin Korhorn's back here in the KFG studios. Thank you again to Sheila Gordy from First State Bank for being with us. Listen, if that really spoke to you and you were wanting some more content, go over to the YouTube channel. There's a little bonus content. We were quizzing her a little bit more on some breaks. And so find us on YouTube, Wise Money Radio. You can subscribe to the episode right there, and every episode's right there, and you've got all the breaks, all the special content is right there as well. Thank you to Bethel College Adult and Graduate Studies, as well as Diane Bennett with RE/MAX 100 for making the Wise Money Show possible. We're about to dive into listener questions, a couple that were texted over, one from Facebook. So if you have any questions, wisemoneyradio.com, or call or text 574-222-2000. That's 574-222-2000. Or like I said, we're starting with a question from Chris. He posted on the Facebook page. You can find us there, Wise Money Radio, as well. All right. So Chris posted this on Facebook a few weeks ago. Thanks for your patience, Chris. If I missed it, please point me to any discussion about pre- and post-tax contributions into a 401k, benefits, disadvantages, all that sort of stuff, which I did reply to you, Chris, so you've got that info. We did a full segment on tax planning back during the spring, and I don't have the episode right here listed in front of me, but if you're curious about those pros and cons, we're going to get into it in just a second, but for more info, find the tax planning show right there early, I believe it was March in 2018. So here's what he said. I currently contribute 7% to my 401k post-tax. My company matches 4% dollar for dollar and then contributes another 8% annually via profit sharing. That's a great benefit. All company contributions, though, are pre-tax. I'm 42 with a long way from retirement. Basically, I think Chris is asking, is that the wise thing to do?
Yeah. Well, I think it's important to also define some of these terms because this is jargon. This is tax planning jargon, if I've ever heard it. And it can also be maybe some confusion on this post-tax idea, right?
I actually asked him.
Did you?
Yeah.
So the issue here, that this is getting into the minutia a little bit, but
We expect that from you, Josh.
Thank you. You can contribute to your 401k typically on a pre-tax basis, meaning the dollars are pulled off the top. It goes into your retirement account before the dollars have ever been taxed, and it allows you to reduce your tax bill this year. What Chris is referring to is post-tax or after-tax contributions, which have been around for a long time, and it's a way for you to pay tax first and then contribute to the 401k, so you have money in that account that's already been taxed. The problem with that approach is eventually you would pay tax on the growth. Now, in more recent years, there's a third option, which is very similar to what Chris has been doing, called the Roth contributions. This also, you tax the money first, then it goes into your retirement account, but when it grows over time, the growth never gets taxed. Mm-hmm. And so maybe Chris is referring to
doing
Roth.
The Roth. Yeah,
okay.
He is doing the Roth. But you need to be aware of that because your pre-tax and your Roth contribution limits are a certain amount. After tax, your company might not even allow you to do that. But if you can, that's even at a different limit. So not to be sticklers.
That doesn't make any sense.
You're confused?
Yeah, I'm confused. I'm trying to follow, and I am totally confused. I get what Joshua was saying. Joshua was saying, hey, if you make $1 and you put it into your retirement plan pre-tax, $1 goes to work for you.
That's right.
If you want to put it in the Roth option, if you make $1, you put that money in your pocket, and in your pocket, you'd have 70 cents in essence. So you have 70 cents to get into your retirement plan. It doesn't work exactly like that, but that's the idea. So I'm tracking with you up to there.
Yeah.
But then you said something that didn't make any sense. So I'm saying if I'm an average dude, the average dude listening saying, Well, what?
For the record, I've never thought of you as an average dude. So
Slightly below average.
If your retirement plan allows it, you might also be able to make after-tax contributions, which, like Josh said, you've already paid tax on those
So
dollars.
you're saying three options:
Right.
pre-tax,
Yep.
after tax, and so the pre-tax grows tax deferred, and all that would be taxable. After tax would grow tax deferred, and all of the growth would be taxable, or the Roth, which would grow tax free, and none of the growth would be taxable.
that's right.
Is that what you're trying to say?
Actually, that's
as
what Josh said.
recently as a year ago, I've seen people making those after-tax contributions, the second one of the three that you were just describing, which is not nearly as good as a Roth contribution.
You got it.
And these folks had a Roth available to them. Mm-hmm. So they would have had the same tax consequences in the year that they're contributing. In other words, they pay tax on their contributions, and then the money gets invested for them. But the difference is, when they get to retirement, are they going to have to pay tax on a whole bunch of growth? The Roth doesn't make you do that.
And that is the spirit of Chris's question. Okay, if we can get back on topic here, is at 42 with a long way to retirement, he is contributing to the Roth portion.
Okay, that's
His
helpful.
company is doing the pre-tax because that's the only way they can do it. Should he be doing this Roth, or should he switch over to pre-tax? That is the question. What do you guys think?
Well, there's an easy answer for that, Chris. At the end of some pretty decent analytical work. So, because really what we want to do is look at your tax situation, and then the question. And I had this conversation with a client yesterday. I looked him in the eye and I said, "Are you a betting man?" And he said, "Depends on what the bet is." and so, because really, Chris, you're going to make a bet in one way or another. There's no way to know what the perfect right answer to this is until you've lived the next 40 years of your life. So what you can do is you can use guiding principles and some financial analysis to determine, am I better off doing this? A big part of it depends on what your tax bracket is.
Yeah, that is. I mean that's where the decision needs to be made as part of your financial plan and looking at your current tax situation and what your tax opportunities are. Now, you mentioned that you're 42 and have a long way to retirement, so that does tip the scales a little bit, but you still have to look at what your tax bracket is.
Well, and I'm reading into this as well. If you're 42, maybe you've got kids in high school that are getting
Exactly.
close to the college years. What we don't know is how eligible will you be for financial aid? And Roth contributions can have an impact on how much income you're showing on your tax return, whereas the more traditional pre-tax contributions, that is sort of the default in most retirement plans, that can actually help reduce the amount of income that's showing up on that tax return, which is exactly what the financial aid folks are going to be looking at when they paint their picture of your eligibility.
And in the spirit of trying to avoid using numbers on the radio, your maximum contribution, Chris, is $18,500. So you could put $18,500 in. If you put $18,500 into the Roth side, and your income was $118,500, you would pay taxes on $118,500. If you put it all in the pre-tax, you would pay tax on $100. So
That's right.
It may be clear as mud, but to Joshua's point, there may be an advantage to manipulating your income down for.
That's why this is such a great financial planning question, really. There's so many different angles that you have to examine this question at. Obviously, it's a tax issue, as Kevin pointed out, but it could also be a question of, well, is the 7% that you're contributing, is that even enough for you to achieve your financial goal as well?
I love the match. I love the profit share, but you're right, Josh. Is it all in together? Is that the right amount to be contributing? The other thing about your taxes, if your income is too high and you've got college-age kids, you might not be eligible for some credits. I had some folks come in last year who sent their first child off to college, and they only got part of the tax credit because they had gotten a bonus. And all of a sudden, their income was a little bit higher than usual. Well, if that's the case, you're going to want pre-tax. And whether or not you definitely need it for your retirement plan, in that case, you might even want to contribute more so you can get more of that tax credit. All of this needs to be baked together. This is why we always preach this, that the right financial decisions for you are made at the connection of all 6 areas of your financial life. And especially with tax laws changing now, everyone should be re-asking, should I be doing Roth or should I be doing pre-tax? Definitely. We've got a great question coming up. Listener sent it in via text about how many repairs should I do for my folks' house before we sell it? That and more coming up here on Wise Money with Korhorn Financial Group. I see it.
You kind of lost me there.
Well, the what you were seeking clarity on, Josh.
Wasn't even part of the.
Josh's what?
So
But yes, it wasn't really part of.
And
the
there
question.
actually is a case to be made for the after-tax contributions.
After
If you're
you've
trying
done
to max, like contribute
No,
above and beyond.
if you were starting a job and you thought it was temporary, well, first of all, if you didn't have a Roth option,
Right.
but if you if you thought your job was temporary and you said, "All right, I'm gonna use this as a savings mechanism," you have a stable value fund that's paying 2.5%. Might be better than what anything else you could make. You leave the job in 2 years. You take your contributions out and use it. And I know that everyone in the financial.
You mentioned principles earlier. I would
I know, well,
argue against that principle.
Well, I know, well, and everyone would.
Yeah.
But if that's part of, to me, the overriding principle there is have a plan.
Mm-hmm.
If that's part of your plan, I wouldn't do that by mistake or by accident, but if that was part of your plan, that is a way to do it. If there's an investment that you can access in your 401k that you couldn't access anywhere else.
Well, and just you mentioned accident, and Josh brought it up too. Yeah, I have. That's why I immediately responded to Chris on Facebook and said, when you say after tax, do you mean Roth? Because there is such a thing as after tax, and you want to make sure that you're contributing to the right one. I had a pastor who was contributing after tax, not Roth
Whoops.
or pre-tax, which of course
Would have been the better option.
right, and just after tax for years.
Right.
Wow.
And so for those of you on the YouTube, it is possible that it's not even close. That by far and away your best option is the Roth, because because for some reason your income is either extremely low, but I'll give you a situation. You have lower income and you don't have an ability to save, but you got an inheritance.
Oh,
And so you're saying, hey, I want to reposition this money to grow tax deferred for me. You wouldn't put it in the pre-tax and create a taxable situation.
all right. Fourth segment. We'll start with the texted in question. We'll hope to get to Susan's question as well. So we'll hope to get to 2 of them in this segment. Sound good? Thanks for being with us today. This is Wise Money with Korhorn Financial Group. My name is Mike Bernard here in the KFG studios with Kevin Korhorn and Josh Gregory. If you've missed anything, you can see every episode right there on the YouTube channel. Just search Wise Money Radio. A lot of banter and additional content on the breaks, and so I would encourage you, subscribe to that and like it. Post any comments if you'd like. You can also find the show online, wisemoneyradio.com. And lastly, every show's podcast. So if you're into binging that stuff, if you've got a family vacation and you're all jumping in the little station wagon there and doing the Griswolds, go ahead and pop the podcast on and listen to several episodes.
Put grandma on the roof.
We are in the middle of listener questions. A great one came from Chris on Facebook. Thanks. Hopefully we didn't get too deep for you. Hopefully that was helpful. This next question was texted in and didn't include their name, age, or location. I'd encourage you, send in your text. Send in your questions via text. But it would be helpful. Share your name, your age, maybe where you live. But here was the question.
222-2000.
My parents are in the process of getting ready to sell their house. They have been living in the house for 45 plus years. How much should you put in for repairs or updates to the house to prepare it for the sale?
It's a great question. And a lot of people, when they inherited a house, they have to deal with that very issue.
Yeah.
It's one of the reasons why sometimes, they don't want the hassle of updating the house after 40 years of, styles and, interior decorating, going out of style, that sort of thing. They just want to get out from underneath this house.
Yeah.
Right? I think it's important to recognize that most buyers really struggle to envision what a house could be. They really can only see what it is right now. It's hard for them to look past that pink bathtub or all that wallpaper or, the brass fixtures, whatever.
The deep orange shag carpet.
That's right.
And the Formica countertops.
That's right. That stuff was cool once,
With the-
I believe. I'm told
The
anyway.
lime green oven.
But this is why it's important to work with a great realtor who can coach you on what's the smart money, what's the wise investment into the house so that you can maximize its value. But it's possible that you could go a little crazy putting a lot of money into a house and not really recoup that investment because the value of the house ultimately is capped by the neighborhood it's in, the houses around it, that sort of thing.
Here's where you're going to be up against it as well. Your folks have lived in the house for 45 years. You've probably looked for at least the last 40 years at what things you would do if you ever had a chance to fix that place up. So you're projecting and saying, hey, the next person that comes in would want to do everything I've always wanted to do. And the dilemma with this is that the market, the real estate market is not static. So if you were trying to sell a house in 2010, it was totally a buyer's market. And we sold a house in 2010, and people would walk in and walk out. And then the realtor would give the obligatory, your house is one of their favorites by far, probably in their top 3. And then you never hear from them again. And so, but people knew exactly what they were looking for, and they had their pick of the litter because there were 2,500 houses in the MLS. Well, today, with 500 houses in the MLS, you don't have your pick of the litter. As a matter of fact,
2,500 buyers.
right?
Yeah.
It is a seller's market. So I would really, and we've benefited from this personally several times. You just have a realtor come in and say, hey, what do I need to do this? And then to me the question is, well, what are you trying to do? Are you trying to get the most money you possibly can out of the house? Because if you are, there may be some things that you need to do that would take a while. Yeah. And you might say, hey, listen, can I just cut my losses? If it's a $100,000 house and you can put $10,000 into it and get $120 out of it, would you do that? Or would you just put it on there as is and take your $100,000 and walk away? So this is where you want to work in conjunction with a realtor that you trust, mm-hmm. and here's how you know that you'll trust them. You look at your siblings. I don't know who you're selling the house with, but you say, hey, we're going to do everything they just told us to do.
Yeah. Mm-hmm. I know that she's a sponsor of the show, so this may sound like a biased opinion here, but by way of testimonial, I will say that this is one of the areas that Diane Bennett's team really excels. Yep. She's worked with some of my clients to sell their homes, and the advice that they come in and give on things like, inexpensive interior decorating or some of the updates that will help make a home more palatable to the buyers that are out there. It's just great advice, and as Kevin said, if you just take the advice and trust that they're leading you in the right direction, it will work out.
And Diane has a team, and that is important because I was looking at this text, and this text could have been sent from one of my clients a year ago, because mom and dad died, and they had the house, and the house didn't have. I don't even remember what the house didn't have, but it didn't have something that's fairly basic.
Central air. It was central air.
Yeah.
I remember.
Okay. So it didn't have central air, which is fine if you don't like central air. I mean, if you're in the market for a house without central air.
But it was a hard one. How much do we put into the house, and how do we get it sold? And Chris, or not Chris, but the question comes in, you're helping your parents. This situation was in a deceased spot, so every month it was sort of, well, we're still paying utilities, we're still paying property taxes. So how do we get this thing unloaded at the right price with as little going into it as possible. We got to move on, but I want to just talk to the other side of you. One side is saying, we haven't updated this house, or mom and dad haven't for 45 years, so what do I need to do? The other side of you had just bought a house. You've been in a house for maybe 2 or 3 years. Updating the house and maintaining the house needs to be part of your budget. It does. And I just have it blocked out in my budget where a couple $100s a month, every single month, goes into a home improvement account. And then when stuff comes up where we need to keep the house fresh, not pristine, you don't want to be pioneers with this stuff, but you need to keep your house relevant, I guess, so that when you do sell, what if it's a fight? What if there's a health issue and you need to sell? What if you've got to move for your job? What if you suddenly pass away and your spouse or your family needs to sell? If there's this big question as to, gosh, where are we going to come up with $100,000 to bring this house into modern age? No, just make it part of your budget. I know that's hard. I know it is because I've done it. It's hard, but I'd encourage you to do that. Next question comes from Susan from Mishawaka. My son is getting ready to go off to school for his freshman year, so I can almost see the tears, Mom. Going off to school at the end of the summer, do I need to get some estate documents in place? I think I've heard you guys talk about that before. Great question. We just had friend of the show, Mark Cornetti, on the program from Ledoux, Kern, and Keene talking about this very issue, and I do. We've worked with Mark for a long time. I know what he would say. It costs money to get something in place, but that child that you're sending off to school is an adult. And thanks to all the bad apples out there in our culture, everything's confidential and private. But they're still your child, and they're still in this critical stage where they're going to need help. The world's going to treat them as if they're an adult and have all these privileges and rights, but yet when they have a need, they're going to still look to you to help solve it.
And that may go beyond even the college years as well. You know, when they've graduated.
Hopefully not too long.
That's right. But if they've graduated, they're out into their working career, but maybe they're not married, then you may still be the person who would come to their rescue if they encounter some sort of a crisis in life, whether that's an illness or an injury or, you know, some other economic issue. And, you know, putting yourself in a position where you can be a true advocate for your son or daughter, even though they are an adult now, is really important. And the types of documents that allow you to do that are things like a power of attorney or an appointment of a healthcare representative, which is sometimes known as a healthcare power of attorney. That is your son or daughter legally authorizing you to help make decisions for them when they can't do it themselves.
One of my best friends, sophomore year of college at Michigan State, had to call the ambulance. He was really in a lot of pain and had to go to the doctor. And his dad's a doctor, so his dad wanted to help. And he didn't have this power of attorney, so his dad couldn't help. It turned out, true story, it was just gas. and he's fine. That is all the time we have for today. Thank you so much for being with us. On behalf of Josh Gregory, Kevin Corhorn, and myself, we'll see you next Saturday for Wise Money with Corhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Corhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.